In this video, we're going to talk about something really interesting, Tesla, and how Tesla basically got its start to becoming profitable and then starting this tear that it's been on. Now, Tesla's been on a tear a couple of different times. People have been shorting it a couple of different times. And we're going to talk today about the thing that's often missed and found in the details to understand what's going on. So let's dig in. One challenge of teaching financial reporting is to prove it, to find something cool. So I dare you to look at this video and not say, oh, that's actually pretty interesting and pretty cool. And it's discovered by looking at financial statements and financial reporting. And I had no clue about it before I started this process. I asked this question about 6 years ago when I started looking at Tesla, because it's an interesting company that everybody kind of likes to follow and people have an opinion on. I got no dog in this race, but I find this interesting. Back in 2014, when I took a job at George Washington University, Tesla all of a sudden was on a tear. It went from $50 a share, $200 a share, in a very short period of time. All right, now it's like way higher than that. During this period of time, right after I got out of my doctoral program, I was creating this class and I said, I got to find something interesting to talk about that's going to kind of hook students into the first class. And this is what I started with. It's just the first one. So I wanted to know what caused the crazy spike after 2013. A lot of people were saying, hey, it's time to short Tesla. It's overvalued. It's been said a lot with Tesla over time. I was trying to figure out, okay, well, what caused the spike? All of a sudden, people were doing a rush into Tesla at this time, and what was causing it? Now you think about it, you got to dial the wheels of your mind back a little bit. Tesla started in 2008. Most people thought this is never going to work, right? How many car companies have started up and been able to dislodge major manufacturers? Automobile startups just don't happen very often at all. Just the process of creating a car is so costly and all the things with it doesn't hardly ever happen. So when Tesla started in 2008, everybody's like, never going to happen, right? They had a couple of things that were going on this period of time. They wanted to show that they had staying power and that the cars would work. And so they had this idea of having this resale value guarantee program. There was so much uncertainty about Tesla that they were willing to buy back the cars at a fixed price so that you knew owning a Tesla, you would at least get a certain amount of money back based on this resale value guarantee program where the company would buy back their cars. It was the first major electric vehicle to come out that was different than the rest. It was different than the Prius and other. There were some questions that come up. What was my question? My question was, how important are hippies? I put a bunch of people on here just so you know, I don't really care. I don't care about, I don't. But I care if I was to buy the stock, I would care about hippies. I would care about the emissions regulations because I know there's some emissions regulations. I don't follow it. I'm not like, I think it's good to be green and things like that, but I don't follow it. I don't really track this. And so I'm familiar with like some tax credits that you might get for buying one of these cars and regulatory credits. And so I was wondering, how important are these things and how critical are essentially hippies for this to go on? Because if regulation is what's driving the success of Tesla, then there's a big concern here because if someone else gets put in power, if something changes, or if word gets out about something that is different or played different, that could have some negative consequences. I want to know how important these people are that are really wanting to get at this stuff. And so the way I find that is you look at the footnotes to financial statements. What are the footnotes? So some questions can't just be answered by the 3 financial reports. You have to go to the footnotes and get into the details. And that's where the tasty stuff is, because that's what everybody always looks over. They look at the 3 reports, they get it, they move on. The details, that's the tasty stuff. Tasty accounting there. All right. When you think about Enron's problems, an analyst said in one of the calls, he said, look, the notes just don't make sense. And we read notes for a living. That's what the analyst said. Enron was trying to cover things up. But if we look into these notes, we might figure out what's going on. So what I'm going to do right now is I'm going to do something live. We're actually going to go into the wild. We're going to go online. All right. Here we go. We are on Tesla's webpage right here. And we're going to sign in. Oh, no. What am I doing? I'm not signing in. I don't own a Tesla. That'd be weird. So here's the Tesla page. All right. So they have all this information and everything on here, solar panels, the different models that you can buy. If you go to privacy and legal, and if you go to invest, so what we want to do is we want to find the SEC filings. The SEC is the Securities Exchange Commission. So we're going to look at annual filings. That's the drop down box. We want to look at 2014, right? Because this will be the ones filed for 2013. And if we look at the spike, so the spike happened right at 2013. That's where we want to. We go back to this and we say, okay, look at the 10K annual report. There's 2 that are listed here. One of them is for Solar City, which is the first one I opened. The second one, this is the one for Tesla Motors. This is the one that we're trying to check out. All right, so we're here on the financial statement. Let's go down and first and just see what's happening in 2013. So if we scroll down, this is the index, and we go to financial statements and supplementary data. So this is the balance sheet. Let's look at consolidated statement of operations. This is also known as the income statement. Sometimes it goes by these different names. All right, so they have automotive sales and development services. This is from selling their cars and their total revenues. This is in thousands. They have about $2 billion in sales in 2013, which is really good. It's way up from 2012. So they do have a gross profit that's profitable of $456 million, but they still are losing. They're losing a lot. They're not losing as much. You see that they're not losing that as much. And if we go over to the cash flow statement, consolidated statement of cash flows, you'll notice this will get us to what's going on with their operating cash flow. And so you have the net loss. So right here at the bottom of cash flow from operating activities, they have an important number, net cash provided by use or used in operating activities. And notice what happened. This parentheses that you see around 2011, so 2011's up here, is they're at negative $128 million. They have to find more money. They got to raise more money for that. Then next year they have $266 million. And then the year after that, they have a gain of $257 million from their operations, from operating activity. All right, so this is why. This is why they spiked in 2013. This is why it went $50 a share up to $200 a share, because all of a sudden, holy cow, they're providing positive cash flow from operating activities, which we got from the statement of cash flows. That's all fine and good, but we want to know why. Well, my question at the time was, well, how much of a factor was the regulation from negative to, over $200 million to positive, $257 million? That's a pretty big swing from negative and positive. How important are the regulations with it? So I started looking up things associated with tax credit that I heard with a federal tax credit of $7,000. But there is these other things that I found as I searched, and it's under regulatory credits. I had no clue about them. And this is what's going to blow your mind. All right. So under California zero emission vehicle regulations, which were California passed and then a bunch of other states passed them. Basically what it says is that you have to have a certain percentage of your fleet be zero emission vehicles that get sold. You just have to. You don't, you're going to have a huge fine. You have to pay stiff penalties. In addition to that regulation, it says something else here. So let's read this part here. Under zero emission vehicle regulations, and those states have adopted California standards, vehicle manufacturers are required to ensure a portion of the vehicles delivered for sale in those states during each model's year are zero emission vehicles and partial zero emission vehicles. Currently, states Arizona, California, Connecticut, and these are all the states that had it at 2013. These laws also provide that a manufacturer may earn credits, referred to as ZEV credits, zero emission vehicle credits. And if they produce more zero emission vehicles than the minimum required by those laws, so those manufacturers with the surplus of credits may sell those excess credits to other manufacturers who then can apply such credits to comply with regulatory requirements. So let me explain this really quick. You're Tesla. All you make is zero emission vehicles. 100% of your cars are zero emission vehicles. If you make over the certain small percentage that the certain states require that are sold in that state, you earn transferable credits that can be sold to other companies. What Tesla does with these is Tesla gets their competitors to pay them to sell cars they were already planning to sell. Oh, okay. So this is interesting. This just got interesting. Tesla gets people to pay them to sell their cars because of the regulations in California and Maine and Maryland and Massachusetts. Okay, that's interesting. I had no clue about that in 2014. So I was like, okay, well, that's interesting. I wonder how important that is. Let's look up these regulatory credits. And it doesn't say anything here. And you'll notice we looked at the income statement. It didn't say anything in the income statement about regulatory credits. It wasn't a line item there. Remember, Tesla's already selling cars. Tesla has to pay for the factory, the employees, the workers. These credits are basically straight profits. They're regulatory profits that are paid by a competitor. I mean, if you have a choice to have your customer pay you or make your competitor pay you, it's pretty clear. Get your competitor pay you because of regulation. That's fantastic. So let's look up regulatory credits and see how important this is. We have entered into contracts for the sale of regulatory credits. So this is in a footnote. For the years ended December 31st, 2013, 2012, and 2011, we have earned revenue from the sale of regulatory credits, selling these credits for selling cars they were going to sell already, of $194 million. This is money that is paid by Toyota, Ford, not to a regulator, but to Tesla to sell cars they were going to sell. $194 million. That's close to $200 million that they got from the sale of these regulatory credits. And they had tried to do it in prior years, and they'd done pretty well. They had $3 million in 2011 and $40 million. But this close to $200 million that happened in 2013, that was a huge deal. Holy cow. Like, if this is not blowing your mind, I don't know what will. So if we look at the Tesla, the 10K, not the Solar City one, we find tax credit, then we find regulatory credit. We find the details. This is the projected time frame of the percentage of vehicles that you have to have in your fleet be zero emission. In 2018, it was under 5%. It jumps up to 10, 15, 20, 25. This ends up growing really fast. These credits are super important to Tesla's revenue. It amounted to over $200 million in not just revenue. This is stuff that doesn't have cost because it's regulation that you're getting your competitors to pay you. This regulation is not small. Regulatory credits, this is where the delicious stuff is. $194 million paid by your competitors. So what was it for 2019? Well, I looked it up. It's $594 million. Just other companies paying, their competitors paying Tesla close to $600 million. This is crazy. That's a lot of money. Imagine working in a market where Pizza Hut has to pay Domino's. It's crazy. It's nuts. This is an important regulation, and it's super important to Tesla's profitability. And so when you think about a regulator or a voter that thinks about making the world clean and green with regulation that picks winners and losers, what car do you think people mostly have in mind? Do you think they were thinking when they came up with this law, the $70,000 car Tesla is, or do you think they had the Prius in mind, the slow putt Prius? Very clearly, I don't think they had the Tesla in mind. There's a dynamic here associated with batteries, Tesla, and the environment that is kind of risky. And then there's the political stuff that is hard to get your mind around, all right? So who's paying for this? Pretty much everyone else that isn't driving a Tesla. That's who's paying for it. And that's a concern. So I don't, let me be clear. I don't have a dog in this race, but I find it fascinating because we're all paying for it. I don't own a Tesla. I wish I could buy a Tesla because it turns out everybody else would be subsidizing my car, right? So Tesla sells their car for a certain price, and that price is set based on how much Tesla needs to make. Tesla doesn't have to ask as much from their customers because they're getting paid hundreds of $millions by their competitors. And where do the competitors get their money? From somebody that buys a different vehicle, like a contractor that might buy a truck or a van that has a certain emission stuff. These are gas guzzling cars. They have to sell these cars at a higher price so that these cars can subsidize and pay Tesla so that they can avoid the regulation. Somebody that buys a van, this guy, my van is subsidizing a Tesla purchase. And definitely it doesn't seem right? It doesn't seem like, you think about who owns all the cars that are not Teslas. And then my friends that own Teslas, they're all like up here, right? They're, all in high-end earners. And so if you think about it, this is a regulation that truly taxes the poor and subsidizes the rich vehicles. So if you're thinking about investing in Tesla stock, one big concern is, are these regulatory credits going to be modified? Is this going to be taken away? Because it doesn't matter what political party you're a part of. The idea that you would tax people that are driving minivans and trucks to subsidize those that can afford Teslas, that's an untenable political argument that I don't think will play in Peoria. That would be my concern investing in Tesla. These regulatory credits, are they going to stick around? Are they going to go? And how long is Toyota going to be paying Tesla to basically sell cars that they should be selling already to wealthy individuals? I find this fascinating. So that's a little bite for the class and what to expect. I'll see you next class where we dive into the details about financial reporting and accounting.